Hello everyone, this is Tom Fox and I'd like to welcome you to episode 273 of the FCPA Compliance and Ethics Report. The FCPA Compliance and Ethics Report is sponsored by the Red Flag Group. The Red Flag Group is a business advisory, information services, and technology firm that helps clients manage risks across four key risk areas: sales and sales channels, including distributors, resellers, partners, suppliers, customers, and human capital, which consists of employees and contractors. You can check out more information on the Red Flag Group at www.redflaggroup.com. I'm also proud to announce my participation in our continuing series of risk management in the supply chain. We have a webinar on Thursday, August 18th at 10 a.m. Central. You can register and find out more information on this webinar by going to the Red Flag Group website and checking the link for webinars. In this webinar, Jared Connors, Chris Sidnick, and I are going to unpack how do you begin to categorize and risk rank your supply chain so that you can move to true risk management. If you're interested in this at all, I hope you'll check it out. The event is free. Once again, go to Red Flag Group at www.redflaggroup.com. Today I have back with me Marc Bohn. Marc is a counsel at Miller Chevalier, and Marc is one of the top writers in the area of equitable remedies, profit disgorgements, fines and penalties in FCPA cases. And he and I and one of his partners at Miller were on a podcast earlier this summer to talk about some of the changes around the issue of profit disgorgement in FCPA cases. And I asked Marc if he could come back and take a deep dive for me into how you would think through the issues relating to profit disgorgement in negotiating with the government, perhaps even the decision to self-disclose. The episode comes in at just over 20 minutes. I think you'll find this very interesting. This is Tom Fox. I'd like to thank you very much for listening to this episode of the FCPA Compliance and Ethics Report. Hello, everyone. This is Tom Fox. Welcome again to another episode of the FCPA Compliance and Ethics Report. Today, I'm very pleased to have back with me Marc Bohn. Marc is with a counsel with Miller and Chevalier in Washington, and he is one of the most prolific thinkers and writers around the topic of equitable remedies, profit disgorgement, and other types of fines, penalties, and remedies under the FCPA. Marc, welcome back.
Hey, thanks for having me.
Marc, you and a partner at Miller were on a podcast earlier to talk about two developments or changes in profit disgorgement as it relates to FCPA enforcement. And you drew for me a need to really visit with you again about the effects of those. But I thought we might start off by talking about, number one, the Graham case out of the 11th Circuit, and number two, the IRS Tax Opinion around the deductibility of profit disgorgement. Perhaps you could remind us of what these changes were.
Sure. So the Graham case involved the SEC appealing a district court opinion that had denied the commission, among other things, a declaratory judgment against 5 individuals that the commission had brought suit against for alleged security violations, and requested the imposition of nearly $600,000 in disgorgement and prejudgment interest against. The SEC claimed the district court erred in finding the complaint time-barred under the U.S. Code because the remedies being sought in the SEC's view were equitable rather than punitive in nature, and the SEC argued that the statute of limitations under 28 U.S.C. 2462 only restricted the application of civil fines, penalties, and forfeiture, but did not extend to equitable remedies, which in the SEC's view included disgorgement. The 11th Circuit, in hearing the case, largely upheld the district court opinion. It found the 5-year statute of limitation for civil claims set forth in the U.S. Code applied to claims for disgorgement. It differed a little from the district court in its analysis. It largely upheld the analysis, but it found that there was no meaningful difference in the definition of disgorgement vis-a-vis forfeiture. It found disgorgement to be a subset of forfeiture, but it sidestepped the issue. Interestingly enough, it punted on the issue of whether disgorgement is equitable or punitive. It drops a footnote and says that that because it determined disgorgement qualified as forfeiture, it need not reach a position on the companion issue of whether disgorgement is a penalty within the meaning of the statute. So that becomes important later as we analyze what the SEC's position is on these matters and what it argues and why it claims that no statute of limitations should apply. But that's the Graham case.
And there was an IRS tax opinion on the deductibility of fines and penalties paid in the form of profit disgorgement. What happened in that opinion?
So there, the Graham opinion, I should note, was not an FCPA case. It was a general securities case. The IRS decision, a memorandum, internal memorandum, did relate to an FCPA case. As opposed to Graham, it's not a precedential memorandum or piece of advice. But what it is the IRS released an internal memorandum. It's called the Chief Counsel Advice. And what it emanated from the IRS's audit of a particular taxpayer, and it reflects the advice that was given to the audit team as they audited this taxpayer. And the CCA, this memorandum, analyzed whether this taxpayer could deduct the disgorgement that it had paid the SEC in connection with an FCPA-related settlement the taxpayer had entered over accounting violations, FCPA-related accounting violations by a foreign subsidiary of its. The CCA noted that under 162F of the IRS code, that a taxpayer can only deduct compensatory payments, those intended to remedy a harm or not punish. And in this analysis, the IRS found that disgorgement payments can be primarily compensatory or primarily punitive, but it's going to depend on the facts. And in this case, it said there was nothing that indicated to the service that the purpose of the disgorgement was to compensate the government for the resources it had expended in bringing this case, or to compensate the victims for their harm, for the harm done to them by the taxpayer's violation. And in light of kind of its analysis, it found that disgorgement was punitive in the way it was applied here, and therefore not deductible.
So I thought that was a really interesting, because to me, Mark, it completely left aside or didn't even address the issue of prior taxes this particular taxpayer may have paid on profits, even if those profits were illegally obtained or at least obtained in violation, in a civil violation of the SEC. But I suppose we'll have to leave that question for another day.
Well, I think it's a really interesting point you make. I mean, there's two different things we're talking about here. The memo applies to whether they can declare disgorgement as a business expense, so the entire amount that they disgorge. Separate from that is the issue, if they're disgorging these profits and they're no longer profits, can they go back and amend the prior year's taxes and recoup the taxes they may have paid on those profits? And I don't think this speaks to that, and I think you're right that we may not get to the bottom of that, but I think it's important for listeners to know that there's two separate issues we're dealing with here.
So, Mark, now that we've kind of laid out these developments, what I'd like to do now is change focus to see how someone like yourself, an FCPA practitioner, would either advise a company, help a company think through the issues, or indeed even strategize how you might want to move forward. And we've developed a hypothetical that I just want to read, and then maybe you can help walk us through at least how you might analyze these. So let's assume that a publicly listed U.S. company with a global footprint has identified potentially improper payments by a wholly owned Latin American subsidiary. The payments were made to a local government official and they were provided to secure a lucrative contract. This U.S. parent had no involvement or knowledge in the misconduct, but they may have consolidated well over $1 million in what seems to be illicit gains, although at the time they were just profits, into its consolidated financial statement. Assuming other factors relevant to self-disclosure, decision, and analysis are equal, how might various disgorgement-related developments that we've talked about, the Graham case and the tax opinion, impact a decision by the company whether or not to self-disclose and how to approach such a self-disclosure? So how would you think through some of these questions, Mark?
a very interesting question. I think as an initial matter, I'd like to point out one interesting thing about the Graham and the CCA decision, and I think this plays into the analysis here, but the competing incentives. So while the CCA memorandum and the Graham opinion could be seen as complementary, they both, while the Graham opinion doesn't explicitly state that disgorgement is equitable, or punitive rather than equitable, the logic that it uses in analyzing declaratory judgment, etc., would seem to get you there. So if they had addressed that issue head on, one would think you would have gotten to the same place. And so it seems like they're in parallel, but what the defendants in each case and the taxpayer are seeking actually are diametrically opposed. So in the Graham case, the defendants lobbied. They argued that, look, disgorgement here is not equitable. It's punitive. It's forfeiture. It is subject to the statute of limitations, and because it's subject to the statute of limitations, the SEC is time barred from bringing this case. It can't bring a declaratory judgment. That's punitive. It can't, at least in their initial view, be enjoined against future violations. The SEC may have, that may be a little up in the air, but basically they argued that because it was not equitable, they forestalled the enforcement action. In the CCA memorandum, the taxpayer wants the disgorgement to be viewed as equitable so that he can deduct it. And so as an initial matter, when considering these things and considering a disclosure and how to disclose and what arguments you're going to make in disclosing, you're going to need to cross that bridge. You're going to need to think about the competing incentives here. The water's a little bit muddy, and you may want to determine whether it's more beneficial for you to go with the argument that disgorgement is not equitable and seek to attack or argue if you're going to disclose, or if you're in negotiations with the government, you may want to argue that it's not equitable and that the statute of limitations applies. Or if it's historic conduct, you may want to argue that it's all past the 5-year statute of limitations. The government couldn't bring a case anyhow, and so we're not going to disclose. We're just going to ensure that we've remediated, and if the government ever comes and asks, we'll respond. Or are you going to want to try to claim that disgorgement and instead be arguing that it is equitable? And so the company is going to have to kind of decide what it's in its best interest to do here. I think that's one interesting aspect of this.
So let me stop you there, though. On the Graham decision, did I understand you correctly that you believe the Graham court held that profit disgorgement was not equitable, and therefore the 5-year statute of limitations did apply to the action brought by the commission?
So the court punts on that issue. The court says essentially the statute of limitations provision in 28 U.S.C. 2462 states that a 5-year statute of limitation attaches to enforcement actions that are seeking civil penalties, forfeiture, or penalties, civil fines, forfeiture, or penalties. And the court seems to state it's not a penalty and it's a forfeiture. And they drop a footnote and they say, because we've determined that it's a forfeiture, we need not address the issue of whether it is punitive or not. And so the issue, however, though, is the way in which they analyze declaratory judgment, and they find a declaratory judgment to be punitive. The logic would seem to support a finding that that disgorgement is punitive as well, but they stop short of going there. And so it's left open. It's not decided, but they clearly allow for the statute of limitations to bar the imposition of disgorgement, or because it's a forfeiture, not because it's quote unquote punitive.
So kind of drawing on your research and your writing on the remedy of profit disgorgement, it seemed to me that we did agree, or at least when it initially came into being, it was a equitable remedy. The remedy was specifically implemented, or rather appended to the Securities and Exchange Act of 1934 in an amendment in 1992 as a remedy available to the department. Do you have any opinion on whether by taking a traditional equitable remedy and making it a statutory remedy, it changes the characterization of the remedy?
Yes, it would seem to. So we need to be clear that we had a circuit split here. We're only dealing with the 11th Circuit. And so if you don't live in the 11th Circuit, that's not the law that applies to you. And the IRS decision has no precedential value. And so it's unclear. The IRS decision or memorandum certainly could indicate that the department going forward will more consistently analyze disgorgement requests for deduction in this way, but it is unclear. In terms of the D.C. Circuit and the Ninth Circuit, there are other circuits that support the SEC's view here. What's interesting, however, is the Graham case comes post-Gabelli, which is the 2013 Supreme Court decision that related to statute of limitations that rejected the SEC's long-held view of when a limitations period begins. It was a 9-0 route where the court fully rejected what had been long-standing practice for the commission to mark when the statute of limitations began by when they discovered the conduct, not when the conduct violation actually occurred. And so Graham certainly isn't required under Gabelli, but I think courts like the 11th Circuit may be viewing these types of issues with fresh sets of eyes in light of Gabelli, and we could see other circuit courts follow suit or uphold and follow the 11th Circuit and what it's doing. I certainly expect the SEC to aggressively contest this matter. Whether the Supreme Court thinks it's ripe for hearing is anyone's guess. They may want it to percolate and see what other circuits say. There's clearly a split in the SEC. If it really wants a case, they may be more deferential to hearing the case. So we'll have to see what occurs there. But it's certainly an issue that's come up. And there's actually a really interesting case that's before the D.C. Circuit right now that it's called Timbervest, and it involves a company that was in a dispute with AT&T, the allegedly wronged party. The SEC charged Timbervest with a variety of securities violations and sought to disgorge $600,000 in profits and prejudgment interest, and in connection with an allegedly improper land deal. And Timbervest, in an effort to moot the matter, went ahead and repaid AT&T the contested sum. So it had realized no profits at that point, illicit profits, and it had actually remedied the wrong and repaid the allegedly wrong party. The case is still before the D.C. Circuit. It'll be interesting to see whether the D.C. Circuit views it as moot or remands it to the SEC. But it raises interesting questions. If a company is potentially under the spotlight for a potential FCPA violation, from the SEC, can it go back and try to give the money back and seek to moot any SEC action by doing so, or at least grounds for disgorgement? So we have this circuit split, and we have the 11th Circuit kind of setting the bar here. It certainly is a departure from how the SEC has traditionally understood this and how courts have typically understood this. I think there's a window for this, however, in that the statute itself doesn't clearly define what constitutes an equitable remedy, and so you have a lot of case law that supports this. But the 19th Securities and Exchange Act of 1934 gives the SEC the authority to require an accounting and a disgorgement, but it never states clearly in the statutory language itself that that's considered equitable. So courts have kind of defined it that way. A range of courts have, including the Ninth and the D.C. Circuit, and now we have an 11th Circuit opinion kind of departing from that. So it'll be interesting to see where things go from here.
So unfortunately, you answered most of the question I wanted to put to you, but let me put it to you perhaps succinctly, which is, in advising a client, you sort of walk through the ways you would think through it, the types of things, the opinions, the circuits, the geographic locations that you have to all factor into your analysis. But when you're sitting across from a client helping them to develop a strategy, do you need to really go into that detail and explain to them the reasons things are not only where they are, but where they could go? Or do you really formulate a strategy kind of based on the best case and move forward and argue to the regulatory authorities based on that?
So I think if a company hasn't disclosed, these are certainly relevant considerations. I think there's going to be a range of factors that a company will make these decisions based off of, and I don't view these as necessarily being dispositive additional factors, but whether a company can deduct the amount that is to be disgorged could have kind of significant tax implications for a company, and whether or not conduct that exceeds a 5-year period that stands outside of that period is open to prosecution is certainly a relevant consideration. So if a company hasn't disclosed and all the conduct occurred prior to 5 years outside of the statute of limitations period, maybe they decide not to voluntarily disclose, and maybe they remedy and wait for the SEC or DOJ to come and have a good story to tell them. On the other hand, it might be a freebie for them to go in and say, this is historic conduct, we've had no issues in more than 5 years, and these are the great systems we have in place. And the DOJ and SEC, I think, are looking for opportunities to reward companies that come in and voluntarily disclose and that kind of have that compliance mindset. But in terms of if a company has disclosed, even if they're not in the 11th Circuit, I think these developments can be helpful to them. It's another quiver and arrow in your quiver to use in negotiations. The fact that the 11th Circuit has found against the SEC on this matter, and the fact that the DOJ or that the IRS determined that at least in one instance disgorgement was not equitable, I think lend themselves to negotiations. The company can go in and make demands, and maybe it determines that it's still in its best interest to cooperate, but it can make these arguments that, look, this is outside of the statute of limitations period, and based on the 11th Circuit, I mean, understanding of this might change, and maybe the SEC is willing to give a little bit more to the company credit-wise if it agrees to a tolling agreement. The interesting thing here is, in terms of kind of everyday practice, a lot of our clients, the issue here is a little bit moved. They've decided to cooperate, and they've agreed to toll the statute of limitations. And so even though conduct may be more than 5 years old now, they've agreed to waive that at least for a specified period of time. And I think those are standard things that the SEC and DOJ always request. Now, the SEC, in requesting tolling of the statute of limitations, never has acknowledged, or they always assert that they still have the right to bring declaratory actions, seeking declaratory judgments and injunctions and imposing disgorgement, even if they can't bring a civil fine, if the conduct is more than 5 years old. But to cover their bases, they've typically always requested tolling agreements. And so, but there's definitely cases out there. You see the fact patterns and you see how far back the SEC is reaching, and it's clear that at least in a few instances, the SEC has gone beyond the 5 years, even without a tolling agreement, and the company has consented to an enforcement action that includes conduct from beyond that scope.
So as typically a defense lawyer representing corporations who've gotten into FCPA hot water, is the Graham decision and perhaps even the tax opinion things that you can utilize really in negotiations with the government, or are we really in the realm of, gosh, this is really just nice to know, Tom?
I particularly think the Graham decision is helpful for companies that are in negotiations with the government, and I think that it adds to the leverage a company has, even if a company is under investigation and the case is being heard or handled in another district, another circuit court. I think that it requires or requires the SEC to be more thoughtful in how it approaches managing these things. And like I said, if you're able to assert that a certain amount of conduct was beyond the 5-year period, the SEC may not acknowledge or concede that they, I think, still believe the 11th Circuit opinion to be wrong, but they may be willing to give you more credit because at least questions about that have been raised. And how hard you can push before you're seen as not being cooperative is a kind of question that's up in the air. I think a lot of companies will want to maintain their cooperative posture and may simply use this to raise questions as a bartering chip, not as something that they're going to seek to argue all the way down the line and ultimately exclude certain conduct because it's beyond that 5-year period. If they've already agreed to cooperate, they may simply use that as leverage.
Well, Mark, unfortunately, we're near the end of our time, but I was wondering if someone wanted to follow up with you directly on any questions, could they email you? And if so, how would they do it?
By all means. My email is mbohn@milchev.com, milchev.com. And I'm open to any email questions. If anyone has any comments or questions about anything I may have said or anything we may have discussed today, I'm happy to have them reach out.
And I would just add, if you want to learn more about profit disgorgement, Mark is the man. So if this is something that your company may be facing, I would heartily suggest that you shoot him an email and start the conversation sooner rather than later. So with that, Mark, I look forward to continuing the conversation with you. And thanks again for taking the time to visit with me today.
Hey, thank you. I appreciate the opportunity, Tom.